Welcome to the fascinating world of value investing. Did you know that Warren Buffett made 99% of his wealth after the age of 50? Or that missing the 10 best days in the stock market over 20 years can cut your returns in half? Shocking, right? These surprising facts highlight the importance of patience and discipline in investing. Value investing is not just about picking cheap stocks. It's about finding hidden gems, staying calm during market storms, and thinking long-term. In this video, we'll uncover the psychological strategies that successful investors use to build their fortunes. You'll learn how to embrace the long game and why waiting can pay off big time. We'll explore the art of selecting the right stocks with a zen-like calm. Discover how to avoid common pitfalls and keep your investment strategy simple yet effective. Ready to dive deep into the psychology of value investing? Let's get started and transform the way you think about investing. Chapter 1. Mind over market. Embracing the long game. Value investing isn't about quick wins, it's about playing the long game. Imagine the stock market as a vast ocean. The waves represent short-term fluctuations, but the current symbolizes long-term trends. Staying focused on the current, rather than the waves, is key. Legendary investor Warren Buffett often talks about waiting for the right pitch when investing. He doesn't swing at every opportunity but waits patiently for the perfect one. This mindset is crucial for value investors. According to a study by the University of California, investors who frequently trade earn an average of 1.5% less per year than those who trade infrequently. This highlights the importance of patience. Investing legends like Benjamin Graham, known as the father of value investing, emphasized the concept of margin of safety. This means buying stocks at a price significantly below their intrinsic value. Graham's strategy allows for errors in judgment and market volatility. One unique fact is that Buffett made 99% of his wealth after the age of 50. This shows that value investing rewards patience and a long-term outlook. It's not about getting rich quickly, but about accumulating wealth steadily over time. In his book, The Intelligent Investor, Graham writes, "The stock market is filled with individuals who know the price of everything, but the value of nothing." This quote underscores the need to look beyond short-term price movements and focus on intrinsic value. Understanding the difference between price and value is essential. Price is what you pay, value is what you get. During market downturns, many investors panic and sell off their stocks. However, value investors see these downturns as opportunities to buy quality stocks at a discount. Patience in investing also means resisting the urge to follow the crowd. Herd mentality can lead to poor investment decisions. Instead, value investors make independent decisions based on thorough research and analysis. Buffett's partner, Charlie Munger, often stresses the importance of temperament in investing. He believes that having the right mindset is more important than having a high IQ. Munger once said, "The big money is not in the buying and selling, but in the waiting." Value investors often say that time in the market is more important than timing the market. This means staying invested over the long term rather than trying to predict short-term market movements. Historically, the stock market has always trended upwards over the long term. Chapter 2. Zen and the Art of Stock Selection. Selecting the right stocks is an art, and value investors approach it with a zen-like calm. The first step is to identify undervalued stocks. This means finding stocks that are trading below their intrinsic value. One way to do this is by looking at the price-to-earnings (P/E) ratio. A low P/E ratio can indicate that a stock is undervalued. However, it's important to compare this ratio to the industry average. A stock might have a low P/E ratio because the entire industry is struggling. In his book, Security Analysis, Benjamin Graham outlines several criteria for selecting stocks. He suggests looking for companies with a strong financial position, stable earnings, and a history of paying dividends. These factors can indicate a company's ability to weather economic downturns. Another key aspect is the company's competitive advantage, often referred to as its moat. This could be anything that allows the company to maintain an edge over its competitors, such as a strong brand, exclusive technology, or cost advantages. Buffett famously looks for companies with a wide moat, believing they can sustain profits over the long term. A unique fact is that the best performing stocks often come from boring industries. According to a study by the National Bureau of Economic Research, stocks from mundane sectors like consumer staples and utilities have outperformed flashier tech stocks over the long run. This reinforces the idea that value investors should look beyond the hype. When selecting stocks, it's also important to understand the company's management. Good management can steer a company through tough times. Investors should look for companies with transparent and honest leadership. One way to gauge this is by reading annual reports and looking for management's discussion of risks and challenges. Cash flow is another critical factor. A company might show profits on paper, but if it's not generating cash, it could be in trouble. Free cash flow, which is the cash generated after accounting for capital expenditures, is a good indicator of a company's financial health. Graham also advised looking at the book value of a company. This is the net asset value and can be compared to the market price. If a stock is trading below its book value, it might be undervalued. Buffett's approach to stock selection involves understanding the business inside and out. He famously invests in companies whose products he uses and understands. This hands-on approach helps him make informed decisions. Chapter 3. Emotional Fortitude: Weathering the Market Storms. Weathering market storms requires emotional fortitude. This means staying calm and rational even when markets are volatile. One key strategy is to have a solid investment plan and stick to it. This plan should include clear goals, a diversified portfolio, and a long-term perspective. John Templeton, a pioneer in value investing, once said, "The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell." This highlights the need to go against the crowd. When others are panicking, value investors see opportunities. It's important to remember that market downturns are inevitable. Historically, the stock market has experienced corrections and bear markets. According to Fidelity, since 1928, the S&P 500 has had 26 bear markets, with an average decline of 35%. Despite this, the market has always recovered and continued to grow. To handle these downturns, investors should focus on the fundamentals of the companies they invest in. If a company's intrinsic value remains strong, its stock price will likely recover. This requires patience and a long-term view. Another strategy is to avoid checking your portfolio too frequently. Constantly monitoring stock prices can lead to emotional reactions and impulsive decisions. Instead, set specific times to review your investments, such as quarterly or semi-annually. A unique fact is that during the 2008 financial crisis, Warren Buffett wrote an op-ed titled, "Buy American. I Am." Despite the turmoil, he remained confident in the long-term prospects of the U.S. economy. This level of confidence and patience is crucial for value investors. Reading books and learning from successful investors can also help build emotional resilience. For example, in The Intelligent Investor, Benjamin Graham emphasizes the importance of having a defensive investor mindset. This means being prepared for market volatility and not letting it affect your long-term strategy. Having a support system can also be beneficial. Discussing your investment strategies with like-minded individuals or mentors can provide reassurance and help you stay focused on your goals. It's easier to stay calm when you know you're not alone in your approach. Chapter 4. The Waiting Game: Profiting from Patience. Patience is a virtue in value investing. The waiting game can lead to significant profits if played correctly. One of the best examples of this is Warren Buffett's investment in Coca-Cola. He started buying shares in 1988 and has held them for over 3 decades, enjoying substantial returns. Patience involves waiting for the right buying opportunities. This means being prepared to act when a high-quality stock is undervalued. In his book, The Dundo Investor, Manish Pabrai emphasizes the importance of waiting for low-risk, high-uncertainty opportunities. These are situations where the downside is limited, but the upside potential is significant. A fascinating statistic is that, according to J.P. Morgan, the S&P 500's best days often occur during bear markets or in the early stages of a recovery. Missing just the 10 best days over a 20-year period can significantly reduce returns. This underscores the importance of staying invested and being patient. Another strategy is dollar-cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. This can reduce the impact of volatility and ensure that you're buying more shares when prices are low. Patience also means understanding that not every investment will provide immediate returns. It can take years for a stock to realize its true value. For example, Amazon's stock price stagnated for years before it became one of the most valuable companies in the world. Buffett's approach to investing is often compared to planting a tree. You plant the seed and patiently wait for it to grow. He once said, "Someone's sitting in the shade today because someone planted a tree a long time ago." It's important to have realistic expectations. The average annual return for the S&P 500 over the long term is around 10%. While some years will be higher and others lower, maintaining a long-term perspective helps manage expectations. Another interesting fact is that, according to Vanguard, investors who trade frequently tend to underperform those who take a buy and hold approach. The costs associated with frequent trading can erode returns, making patience even more critical. Chapter 5. Discipline Dilemmas. Avoiding common pitfalls. Investing discipline is essential to success, but it's easy to fall into common pitfalls. One major pitfall is overconfidence. According to a study by Barber and Odeen, investors who trade frequently often overestimate their ability to pick winners, leading to lower returns. Staying humble and acknowledging your limitations can prevent costly mistakes. Another common mistake is chasing trends. It's tempting to invest in the latest hot stock, but this often leads to buying at inflated prices. Instead, focus on the fundamentals and intrinsic value of a company. As Peter Lynch said, know what you own, and know why you own it. Emotional investing is another trap. Making decisions based on fear or greed can lead to poor outcomes. During market downturns, fear can drive investors to sell quality stocks at a loss. Conversely, greed can push investors to buy overvalued stocks. A disciplined approach involves sticking to your investment plan regardless of market emotions. Market timing is also a common pitfall. Many investors try to predict market highs and lows, but even experts struggle with this. According to Morningstar, missing just a few of the market's best days can significantly impact long-term returns. Instead of timing the market, focus on time in the market. Diversification is a key strategy to avoid significant losses. By spreading investments across different sectors and asset classes, you can reduce risk. A well-diversified portfolio can weather market volatility better than one concentrated in a few stocks. This doesn't mean buying everything in sight, but rather, choosing a mix of investments that complement each other. Another pitfall is neglecting due diligence. It's crucial to thoroughly research a company before investing. This includes understanding its business model, financial health, competitive landscape, and management team. Benjamin Graham stressed the importance of doing your homework, saying, investing isn't about beating others at their game. It's about controlling yourself at your own game. A unique fact is that, according to Dalbar, the average investor underperforms the market due to poor timing and irrational decisions. Over the past 30 years, the average equity investor earned about 3.7% annually, while the S&P 500 returned about 10%. Chapter 6. The Serenity of Simplicity. Keeping your investment strategy clear. Simplicity in investing can lead to better results. A clear, straightforward strategy is easier to follow and less likely to lead to mistakes. Warren Buffett often advises investors to stick to what they understand. This means investing in businesses you can easily grasp. One effective strategy is the KISS principle. Keep it simple, stupid. This involves focusing on a few key metrics and not getting bogged down by overly complex models. For instance, looking at a company's earnings, cash flow, and debt levels can provide a good overview of its financial health. A unique fact is that, according to a study by the Journal of Financial Economics, simpler investment strategies tend to outperform more complex ones. Over a 50-year period, a straightforward buy and hold strategy in the S&P 500 outperformed more complex trading strategies. Index investing is a prime example of simplicity. By investing in index funds, you can achieve broad market exposure with minimal effort. Index funds have historically outperformed most actively managed funds due to lower fees and reduced trading costs. John Bogle, the founder of Vanguard, was a strong advocate for index investing. He believed that the simplest approach is often the best. His philosophy of low-cost, passive investing has helped millions of investors achieve their financial goals. Another strategy is to focus on quality over quantity. Instead of owning dozens of stocks, concentrate on a smaller number of high-quality companies. This allows you to thoroughly understand each investment and reduces the complexity of managing your portfolio. In his book, One Up on Wall Street, Peter Lynch advises, never invest in an idea you can't illustrate with a crayon. This highlights the importance of being able to explain your investment thesis in simple terms. If you can't do this, you might not fully understand the investment.